You're listening to the Learn Like a CPA podcast, where we talk about all things real estate, tax strategy, and personal finance. Whether you're a real estate investor looking to scale your portfolio, or you're an individual wanting to take your financial freedom journey to the next level, this is a podcast for you. Welcome back, everyone, to the Learn Like a CPA podcast. Today, we're going to be taking a deeper dive into real estate professional status. So let me tell you something. If there's a section of the Internal Revenue Code that's more favored towards rich and wealthy people, I don't know about it, because this has to be, and it's not even a loophole, right? People want to say, oh, these are tax loopholes. It's clearly defined in the code that you can be what's known as an IRS designated real estate professional. Again, if there's anything in the code that is more favorable to rich and wealthy people, I don't know about it. Let's give you some background on why the tax law was broken and now it's fixed, but also still kind of broken. Before 1986, all income that you earned or received was the same, which meant you could be earning a ton of money as a dentist, doctor, lawyer, invest in real estate, generate losses, and be able to use your real estate losses to offset your ordinary income or your day job income. So I could be that doctor who's making $1 million a year, as long as I invest in enough real estate that's going to generate me losses. And again, these are paper losses, right? We're able to get creative with tax strategy and depreciation, and we're able to generate these real estate losses that we're able to offset our income. This was a big problem because wealthy individuals were able to offset their entire income by investing in rental properties. And it wasn't until 1986 that Congress ultimately put a stop to this by creating two categories, or two what people refer to as buckets of income. You have non-passive income like your W-2, 1099, stocks, gambling income, if you guys like to gamble. Non-passive income and passive income. And passive income, within regards to these two buckets, is defined as, by default, all rental real estate is passive. So my short-term rentals, long-term rentals, commercial buildings, syndication deals, those are all going to be sort of passive activities, right? And any activity in which you do not materially participate in. So an example of that is, let's say I have a friend who owns a hair salon or a laundromat, and all I do is cough up money and I kind of sit back. I don't make any decisions. I'm passive. That's passive income to me. And I can use that passive income or loss to offset other passive activities or losses. So it wasn't until 1986 where they put a stop to this by creating the two buckets of income, right? So now your doctor, lawyer, dentist buddy isn't able to use his real estate losses to offset his income. And what happened is real estate in general have probably the best lobbyists out of anybody, but real estate lobbied Congress to come up with real estate professional status in 1993. They were saying, well, hey, we're not trying to break any rules here, or we're not a dentist or a doctor making a ton of money. We're real estate professionals by trade, and we do this on a day-to-day basis. We should be able to also take our rental losses against our income. And that's when they came up with real estate professional status in 1993. But why is REPS so powerful, right? Real estate professional status, or REPS for short. Well, you're able to offset ordinary income, again, W-2, 1099, stocks, with your rental losses. So you're able to generate cash flow, right? You're able to generate cash flow from your rental properties, but also show a loss for tax purposes. Use that loss to offset your ordinary income. And from there, you're creating tax savings, which you're able to reinvest in your rental properties, buy more properties, or perhaps further other business adventures. What's also cool about real estate professional status is that you do not have to pay net investment income tax if you are a real estate professional. For those of you who don't know, net investment income tax is a 3.8% surcharge on all investment income if you make over a certain amount. So once you start becoming a higher earner, that net investment income tax kicks in. However, if you're a real estate professional, you are not subject to net investment income tax. So how do you qualify as a real estate professional? So the litmus test that I tell everybody is, if you or your spouse have a full-time job a full-time W-2 job in a non-real estate field, you are not going to qualify, okay? Because one of the important qualifications is that you have to spend more time in real estate than your W-2. So I'm a CPA, right? I might work 2,000, 2,500 hours a year at my firm. That means I would have to work 2,001 hours in real estate in order to qualify as a real estate professional. My hours towards my practice do not count. They have to be hours that are spent specifically on my rental properties. So the big litmus test is if you have a full-time W-2 job, you are not going to qualify as a real estate professional. So let's kind of talk about what are the qualifications, right? So what we have to see here is for real estate professional status, there's going to be two sort of qualifying tests and then a third, what is called material participation test, okay? So for these two qualifying tests, first you have to meet these two requirements, and then you have to meet the third material participation test. And I'm gonna outline them on the whiteboard here. The first qualification is that you have to spend at least 750 hours in a real property trader business, okay? So you have to spend 750 hours. Now, if you are, let's say you're a fix and flipper or you're a real estate agent, you can use these hours to count towards real estate professional status, right? So 750 hours in a real property trader business. If you are not a real estate professional by day, you would have to spend 750 hours in your rental properties alone, which could be very hard. The second part is you have to spend more than half your working time has to be in real estate. More than half working time, which again, if I'm spending 2,000 hours at my W-2 job or my CPA job, I would have to spend 2,001 hours in real estate. It's not going to happen. That would be like me working 85 hours a week every single week out of the year. I do work 85 hours a week some weeks, but not every single week out of the year, right? So once you meet these two sort of qualification tests, you're still not done yet. There is a third, what's called material participation test. Material participation. Okay. And now there's 7 of these tests. So we're just going to do 1 through 7. However, I would say the 2 that we see the most common are, number 1 is going to be a 500-hour test. Okay. So you'd have to spend 500 hours in your rental properties that you own. So if you have a property manager, you're most likely going to be out because you're not going to be able to count your time that's spent in those properties if you have a property manager, because the argument is, what exactly are you doing, right? If you hire a property manager, they're supposed to take care of that for you. So it's really hard to prove that you're getting hours there if you also have a property manager. So the 500-hour test, and there's also a 100-hour test, and more than anyone else. And the reason being with these two different types of tests is they want you to prove that you spend a substantial amount of time in these properties. Again, you have to be actively managing your rentals and meet these hours requirements. You can't just hand off the properties to property managers. So again, the 2 qualification tests, 750 hours in a real property trader business and more than half your working time. But that doesn't get you there yet, okay? You still have to prove that you materially participate in your rental activities, okay? So if you just have one property, you'd have to meet most likely the 100-hour test and more than anyone else. If you have multiple properties, you might be able to hit the 500-hour test. If you have more than one property, you are able to group all the properties together under what's known as the -9 election. Okay, you make an election to group all your rentals together, and you're able to count all those rental activities together towards that 500-hour test. So to kind of draw out or just kind of explain, using a case study, let's say a taxpayer is single and he makes $250,000 a year, okay, at a brokerage. So he's a real estate broker. The taxpayer is also going to purchase a $500,000 long-term rental fourplex. And let's just say for numbers' sake that he bought it towards the end of the year. So maybe the long-term rental fourplex cash flows $20,000 a year, okay, is in cash flow. but they're going to be able to generate $100,000 of depreciation in the form of bonus depreciation. Okay, so they have $100,000 of bonus depreciation for a total loss, tax loss of $80K. Okay, and they're also able to qualify as a real estate professional. So if we go back, they're able to meet the 750 hours test. They're able to meet the more than half their working time, and they spend that time working in their rental property. Assuming they meet these qualifications, they're going to be able to take this $80,000 loss right here against their $250,000 of income. And in this taxpayer's case, they're able to save $30,000 in taxes by qualifying as a real estate professional. So they meet step number 1 and 2. You have to be a real estate professional by trade, right? So this person is a real estate broker, so he's going to spend that time, right? More than half his working time, 750 hours. But they're not done yet, right? They also have to meet that material participation test in that rental that they buy, right? But assuming that they're able to meet this, they're able to use this tax loss, this $80,000 loss, to offset their $250,000 of income and generate tax savings that way, right? So it's if you're a real estate, full-time real estate, whether it's an agent, flipper, property manager, broker, you have to look into qualifying as a real estate professional. It is so powerful from a wealth building perspective that you cannot pass up on. So go ahead, dive into this content, play it over again if you have to. I have other content that's centered around real estate professional status. You have to learn this. If you are in the real estate field, you have to learn about real estate professional status. Some of the key takeaways: real estate professional status is highly litigated in the tax court, and for good reason, right? Just because of how powerful it is, right? We're able to have cash flow, but generate these paper losses that we're able to use these losses to offset our W-2 income, our 1099 income, stock income, gambling income. We're able to generate these fake losses to offset our W-2 or non-passive income. Remember, you will not qualify if you have a W-2 job that's in a non-real estate field. However, only one spouse has to qualify as a real estate professional. So one of the common strategies is to have one spouse qualify as a real estate professional. Maybe they're a broker, a wholesaler, a flipper, and have the other spouse potentially manage the rental properties, because you are able to do that. Just remember that one spouse has to qualify as a real estate professional. Real estate professional status is a great way to harness the tax code and use the tax code to help fuel your next investment, right? That person who saved $30,000 in taxes is able to use that $30,000 on a down payment for the next property and almost repeat the same steps, right? Meet our hours requirement, buy property, use a tax advisor, help you accelerate the depreciation and strategize, and so that way you're able to achieve massive tax savings. That's going to be it for today, guys. We covered real estate professional status top to bottom. We talked about the beginnings of it, what it looks like today. We went over a case study. I'm going to be speaking at a boot camp in June. I'm going to be at the Short-Term Rental Wealth Conference that's going to be in Nashville. So I look forward to seeing you guys there if you can make it. I will also be hosting my first boot camp this fall centered around short-term rental tax. If you want information about it, as well as early bird pricing, check out the link in the show notes below. And if you like this show, be sure to give me a review on Spotify and Apple. And if you have any questions you'd like me to answer on the show, hit me up on Instagram or Twitter at LearnLikeACPA. Thanks for listening, and I'll see you guys in the next episode.